Your mortgage payment could be $300 per month cheaper. Here's how to get it. Imagine locking in a 3.5% rate instead of 4.5% on a $400 loan. That's not a hypothetical, it's happening right now in new construction markets. But here's the catch, most buyers don't know how to ask for it, or when it actually makes sense. On The Money Decoded, we break down complex financial concepts, and today's topic is one that could save you hundreds every month. Let's start with the basics. When you see a mortgage rate listed as 4.5%, that's the stated rate, but it doesn't tell the whole story. A rate buydown is when the seller or builder agrees to temporarily lower the interest rate, often as an incentive to close the deal. It's different from discount points, which are fees you pay upfront to lock in a lower rate permanently. Think of a buydown as a temporary discount, while points are a permanent trade-off. Here's how it works in practice. Suppose you're buying a $400 home with a 20% down payment. At 4.5%, your monthly payment would be about $1,850. But if the seller offers a one-year rate buydown to 3.5%, your payment drops to $1,550, a $300 per month savings. That's the kind of math that makes people rethink their negotiation strategy. But why would a seller agree to this? In new construction, builders often offer buydowns to move inventory. In competitive markets, sellers might sweeten the deal to attract buyers. The key is understanding when these offers are available and when they're just a marketing tactic. Now, here's where it gets tricky, not all buydowns are created equal. Some are tied to specific timeframes, like 1 year, while others might require you to repay the difference if you sell the home early. You'll need to read the fine print and ask your agent to clarify exactly what's being offered. Let's dive into the numbers. A 1% rate difference on a $400 loan doesn't just affect your monthly payment, it impacts your total interest over time. At 4.5%, you'll pay about $168,000 in interest over 30 years. At 3.5%, that drops to $128,000, a $40,000 savings. But here's the catch, that's only if you stay in the home for the full term. If you're planning to sell in 5 years, a buydown might not be worth it. The savings from the lower rate would be offset by the upfront cost of the buydown, if any, and the potential need to reimburse the seller when you leave. That's why it's critical to run the numbers with your lender and real estate agent. Another consideration, not all lenders offer buydowns. In some markets, especially where inventory is low, sellers might not have the incentive to sweeten the deal. You'll need to ask directly and be prepared to negotiate. If the seller is motivated, like a short sale or foreclosure, they might be more open to a buydown to close the deal faster. Let's look at a real-world example. In Phoenix, a buyer on a $450 home with a 10% down payment negotiated a one-year rate buydown from 5.25% to 4.25%. That dropped their monthly payment from $2,100 to $1,850, a $250 per month savings. But the seller only agreed to it because the home had been on the market for 6 months. The takeaway? Timing and seller motivation matter. So how do you actually request a rate buydown? Start by asking your real estate agent if the seller has offered this incentive in the past. If not, be prepared to negotiate and know your leverage. If the home has been on the market for a while, or if the seller is motivated, you might have more room to negotiate. When you make an offer, include a clause that asks the seller to consider a rate buydown as part of the deal. Be specific, we're requesting a one-year rate buydown from X% to Y% as part of the purchase agreement. If the seller agrees, your lender will handle the paperwork to lock in the lower rate for the agreed period. But here's the most important thing to watch for, some buydowns require you to pay the difference back if you sell the home early. That's a red flag. Always ask, is this a permanent rate reduction, or is it temporary? If it's temporary, make sure you understand the terms and whether you'll have to reimburse the seller if you move before the buydown expires. Another option, instead of a seller-funded buydown, consider a builder-funded buydown in new construction. Many builders offer these as part of their marketing strategy. In those cases, the builder typically absorbs the cost and you get the lower rate without affecting your closing costs. If you're considering a home purchase, hit subscribe, we break down strategies like this every day. A rate buydown can save you hundreds a month, but only if you know how to ask for it. Next week, we'll break down how to negotiate closing costs without burning bridges. Stay tuned.